feel like with the simulation last week, last time I set a high bar, and I tried really hard to make it as good or make it as interesting. I kind of went with a different direction. We'll see how it goes.
Okay.
But this is just an experiment.
Yeah, yeah. The book was fun to read. You know, I didn't read the whole book. I didn't get through the whole book, but it's just so relevant to life, right? Day in and day out, the interactions you have, the conversations you have.
Yeah.
You see the stuff play out all the time.
Yeah. And I think, as a parent of two young kids, it's something definitely that I want to push them toward.
Yeah.
Anyway, maybe we should start. It's 8:10. I'd like to start off with a quote from Benjamin Franklin that I think sums up the scout mindset. The older I grow, the more apt I am to doubt my own judgment and to pay more respect to the judgment of others. So I think, the scout mindset is about always learning, challenging your assumptions, and having the truth be the overall goal. Same rules, be respectful, no politics, and have fun. But actually, there is a section in the book where they talk about political debates. And so in the spirit of that, we're going to allow politics. Yeah, so yes, politics, if appropriate, but no insults, don't generalize, and don't only disagree with specific views. I also like to recommend this podcast. This series of debates called Open to Debate. Their mission, and I quote, is to restore critical thinking, facts, reason, and civility to American public discourse. They take certain topics, recent topics, and they go through a debate. They get someone on the pro side and the con side, and it's very civil. And a lot of them I've listened to, and I've actually changed my mind on quite a number of them. So definitely check it out if you can.
Okay.
So yeah, who here liked this book?
I liked it.
Samir, okay, fan. Philip, did you read the book? What did you think?
I was halfway listening to the audiobook version, so I don't have a good comment on that.
Okay. Foss, did you get a chance to read the book?
No, but that's why I watched the TED Talk.
Okay. All right. Okay, cool. So let's just jump ahead. So this is a comic about cognitive dissonance. I don't know if anyone here is familiar with it. It's a concept from psychology that basically says that if you have two competing ideas in your head, that causes a lot of discomfort. So what people do is they don't like that discomfort, so they suppress one of those ideas. And so in this comic, if your numbers are correct, my strategic plan is irrational, and then the cognitive dissonance takes over. You sure are bad with numbers. What was that noise? Okay, so another classic example is, oh yeah, the S&P 500 is a great benchmark. Oh, but I underperformed the S&P 500. Oh, so okay, so maybe the S&P 500 is not a great benchmark. You can imagine a lot of people going through that, in their investment journey. And to illustrate this further, I have another comic. People rather have comforting lies than unpleasant truths. And this is obviously very dangerous, especially when you're dealing with money. And so my first question is, what cognitive biases impact the decision-making process for investors and traders? In other words, when is the investor like that boss in that Dilbert comic? Anybody have any thoughts about that?
There's so many.
Yeah, there are a lot.
The first one that pops in mind is the sunk cost. Like if you have a loss, you don't want to exit.
Yep. That's a great one. Yeah. Anything else?
An alternate version that your initial proposition was to go in on a short-term trade, but you miss the stop and it becomes this was a long-term buy anyway.
Right.
Okay. Yeah.
Confirmation bias. You have a thesis on a company, you can only see that thesis.
Yep. Yeah. You seek out information that agrees with you. Yeah. Anything else? Samir, can you think of anything?
I guess I'm thinking like the VC world, right? Where one VC invests and suddenly everybody else wants to invest,
Yeah, like a herd mentality.
Yeah. Where you want somebody else to make the first move, and then you're more comfortable making the move after that.
I see.
That's so prevalent. People brag about social proof.
Yeah. Any other biases or things we can think of? So I actually came up with a list of 16, and we can go through them one by one. Okay, so recency bias, and the whole book is about sort of that soldier mentality where they're defending their ideas or their thoughts. So, you know, recently buys, we tend to overweight what's happening today. Yeah, I mean, like for example, everyone's talking about NVIDIA now, right? Because this is in the news, it's very prominent. But so was crypto 2 years ago, right? Status quo bias, you know, depending how it is now. You can look at like how many people actually still use Excel now, right? Just because they're just so used to it. Availability bias. I think as a quant, especially, a lot of people use closing prices for US stocks because that's what's available. Anchoring bias, you know, when you put on a trade, you might anchor to that price. Confirmation bias, threw that one out. Selection bias. And I've actually seen this a lot, where somebody would come up with a back test, but they're like very specific about where they want to implement. Oh yeah, only the past 3 years. We'll kind of ignore, you know, during any crashes. Or yeah, affirmation bias. So like yeah, an affirmation bias is like, you know, if you're a value investor, for example, you know, everyone always says like, oh yeah, value is back. Value stocks do well for a month or so, and they always say value is back. Overconfidence bias, like defending one's own ability. And I think that can be very dangerous for obvious reasons. Oh yeah, and which is also very different than optimism bias. Like everyone thinks they have a better chance than what's realistic. Hindsight bias. And so I actually saw this back test recently about how someone came up with a back test and they kind of like maneuvered their way so they would avoid any crashes in 2008. And of course, if they did that, then the CAGR was awesome, the returns were awesome, and it looked a lot better than S&P 500. I mean, essentially, like, you know, here's a strategy: risk off in 2008, and oh yeah, bam, now it looks fantastic. And I think I've seen a lot of back tests where essentially that's what it is. But you know, would you have known to avoid those stocks or whatnot, or risk off in 2008? Attribution bias. So, you know, I have a lot of relatives who dabble in the stock market, and the market goes up and they make money and they kind of attribute to their own skills, whereas you know they're just basically long beta.
Yeah.
Illusion of control. We talked about this last week, where you think you have element of control for future results. Yeah, defending one's self-image, identity traps. So, like for example, you know, maybe some people come in like, oh yeah, I'm a value investor, or oh, I'm a quant, so I got to do things in that way. That's kind of the way I do things. And you know, that might not necessarily be the case. I think people should be more sort of open to all types of investing and trading. Echo chamber effect. You know, we've seen this in Wall Street Bets on Reddit. You know, everyone basically saying the same thing, and that kind of reconfirms what you're thinking. Endowment effect, like, so like just because you do it, you or it's your idea, you play much more heavy weight onto it. And my last one, sunk fallacy, as Klaus mentioned that as well. So yeah, so there's like a lot of like booby traps, right, for investors. And has anyone here heard of the Dunning-Kruger effect?
Yeah.
So yeah, that's. Has anyone seen this plot before?
Yeah, I've seen this.
Yeah. So for those who are not familiar, basically it's saying where you have a little bit of knowledge and then you think you know everything, and then the more knowledge you get after that, you realize how little you know, and then finally you start understanding really what is going on. So my next question is, you know, what key concepts are commonly misunderstood or underestimated by new investors or traders?
Oh, actually, Jonathan, if I can add 2 more biases to your earlier.
Oh yeah, okay, cool, yeah, please.
It dawned on me that there could be 2 more additions. One is what I would call a love bias, in the sense that you fall in love with the stock.
Yeah.
And you dump it. And the other one is the memory bias, because in the past, if you got hit $1 yen at 100, and over the next few years, every time you hit 100, that becomes a mental barrier that you either get out too soon or you refuse to get out. So,
right.
So that's what I would think a memory bias.
Yeah. That's kind of like anchoring. Like you kind of anchor on a specific price. But yeah, I think a lot of these biases are. There's a lot of overlap between these biases, but yeah, like selective memory for sure. You know, a lot of people talk about keeping an investment journal, just because they're aware of what they were thinking at the time. Yeah, I think might be a good idea. All right, so yeah, back to this question. What key concepts are commonly misunderstood or underestimated by new investors or traders?
I think maybe some of that's, and maybe I am one of those people because I'm not a professional investor. This idea that you feel confident that you can time it.
Yes.
The entry and exit.
Yes. Yeah, I was at a hedge fund, and there was a professor who was one of the PMs, and he suggested that, oh, maybe we should just buy as the market's going up. And it really surprised me because it seems like such a simple thing to conceptually. It seems like, oh yeah, we should just do that. As it's going up, we buy it, and then as it's going down, we sell it, right? But there's a timing issue there where it basically makes that impossible, right? Like you don't know it's going up until after the fact, and you don't know it's going down until after the fact. So yeah, that's one thing that people kind of not get when they start off trading.
Costs is another one, I think, that people overlook.
Yes, like bid-ask spread. What else? Just the impact.
Yeah, slippage and impact.
Yeah, slippage, the impact. Also, just like having an impact on the stock price itself when you do large size. Yeah, I think that's a huge one.
Another one that I think is really common for independent quants is finding something that works in a liquid part of the market, and then kind of assuming that it will work everywhere in the market.
Okay.
So like the liquid parts tend to be less efficient than the liquid parts of the market.
Right. Yeah. Anything else?
This came up in a conversation with someone recently about how big the moat is for, an established trading firm in terms of the amount of research they've done, the quality of the data they have, the infra they've built, the understanding of the market microstructure, and how well-oiled machine that is. And then someone new comes into the space, I guess they don't recognize what they're up against.
Yeah.
They think, well, if they can do it, I can do it. It's like me going up against Usain Bolt and thinking it's a 100-meter sprint. I'm surely I can keep up with him. He's gone in like 5 meters, absolutely gone.
Yeah. Actually, there was a blog post I read about Jim Simons. Kind of tie it back to the book club 2 books ago. But what I heard was that Renaissance, like each individual signal that they use, would not make money on its own. And it's really just the collection of all the signals that they use is really how they're able to make money. And so, I think a lot of quants are looking for that one signal, but that might not be enough.
Oh, because I was reading a couple of months actually, a comment by Druckenmiller that the most amount of money that they make are usually when markets are going down in a contrarian manner.
Okay.
And that conflicts with the popular momentum trade where you follow the flows. But then also I feel that the misunderstood or the underestimated concept is the mindset that the momentum is a perpetual game, that in all cycles it would definitely be a money-making exercise, or on the other hand that momentum trades are unpreferred because it's not reliable. I think it's conditional. There are certain environments where momentum trades are good, some environments where the contrarian buy when markets are against you a good setup. So that I would consider them as, usually when I look at it, I would bucket that as a distressed security setup, as opposed to a momentum where you are chasing the flows.
Mm-hmm.
The mindset is that are your stops tighter or broader?
I see.
I'm going to be wrong, but just sharing my mindset.
Yeah.
So I came up with a list of commonly misunderstood or underestimated by new investors. This might be controversial, but the efficient market hypothesis. It's not perfect, but I think it starts as a good baseline about what it actually means, about how information is reflected in a stock and the timing of it. Like there's different, I would say that for liquid stocks, the markets are fairly efficient, whereas for illiquid stocks, markets are inefficient. It's also related to supply and demand. basic supply and demand. Everyone's fighting for the same S&P alpha, like the stocks in the S&P 500 fighting for alpha there. But meanwhile, where like Jane Street is killing it with Indian options, where like nobody's looking at it, right? I think from the basic laws of economics, less competition means more profit, and I think people sort of miss that. Positive expectancy and the role of the law of large numbers. I think that's also very important. Looking at each individual trade as a bet, and then evaluating whether it's a good idea or not, or having some sort of concept of what the expectancy is. Competitive advantage. I think there's that saying, like, if you don't know who the fish is, then the small fish is, then you're probably that person. I think it's really important to be able to identify what your edge is, and it can't be like, oh, I'm smarter than everyone. Some people might say, oh yeah, I found something that nobody else has, but I think that's a little bit disillusional, because like you got bajillions of people out there with computers looking for the same patterns, and I think perhaps it's naive to think that you found something that nobody else has found. That being said, if it was like in Indian option markets, then it's more believable, because not many people are looking at it. Another concept, good companies doesn't necessarily mean good returns.
Mm-hmm.
Yeah, you have a lot of retail people saying, oh yeah, this is a great company. So, but it's all about expectations, or whether that information is priced in the stock or not. Transaction costs, we talked about that. Adverse selection. So, basically, like if something's too good to be true, there should be something in the back of your mind saying, oh yeah, it probably is too good, and I'm missing something. If you're the type of investor or trader who thinks that there's just like $100 bills lying around for you to pick up and no one else is picking it up, I think it's a little bit naive. So yeah, so randomness. We kind of touched on this last time, where people, it's very it's very easy to be fooled by randomness. People don't understand, like what one sharp strategy looks like, or a 2 sharp strategy looks like, right? Like there's tons of volatility in those things, and you can have a great manager, as I showed last time, where they're in the long run they're expected to outperform the market, but 5 years is not enough data. Risk management, a lot of people don't look at that. Another one that I think is really big is like volatility tolerance. I've heard people like, oh yeah, if only I could invest in Amazon 20 years ago, I would be super rich. But there are a lot of ups and downs that went with that chart, right? And because when you look at a price chart, it's it grows exponentially. You don't see like the swings in it. I would say most people, their risk tolerance is much lower than they realize. Risk aversion, the pain of losing money is much more hurtful than the gain that you get when you make money. Market timing, Samir, you kind of alluded to that earlier. Liquidity risk, and then another big thing is like tax implications. That is, it's probably as big as transaction costs. It's not enough to beat the market. You also have to, beat it substantially to make sense, for it to make sense from a tax perspective. The concept of exponential growth, I think that's, I think Warren Buffett or somebody said like that's like one of the wonders, one of like the 8th wonder of the world is compounding.
Yeah, compounding's the 8th wonder of the world.
Yeah. So I gone through a lot here. Anybody else have anything else to add?
I'm just wondering, what about if you have a small shop, right? You've got one person or a small number of people, and I guess you run a one man shop, right? So what about as an individual goes through ups and downs, and I run a one man shop as well, right? And so the impact of that on the business, as opposed to having 1,000 people investment firm, and if one person's having a bad month or a bad week or a bad day, the overall impact on the company is I assume negligible. So for someone that's new in the world of trading, perhaps starting their own shop, they haven't sort of considered what happens when they're not performing at 100% or 95%, all the time, which they won't all the time.
Yeah. So I'll give you a little backstory. So for a long time, I was a market maker in sports markets, and essentially I had a Sharp of 10, which is basically printing money. I think I've had maybe one down month, but like there were still ups and downs. to that. And it's very easy to get very emotional from that. Like in the back of my mind, I'm like, I look at the numbers like, this is a sharp of 10. This is amazing. I should just be happy. But as you're going through it, you still feel those bumps, those ups and downs. And I would say, as a trader and an investor, like I've learned to tolerate that volatility. So in many ways, as a one-man shop, you actually have a huge advantage. I think that for a large company, like there's a very low tolerance for volatility. I think as an individual, if you have a strategy that you strongly believe in, and yeah, I mean, you just deal with the ups and downs.
Yeah, I guess I'm talking about the kind of volatility, if I may, within the human,
Yeah,
in their focus, in their commitment, in their discipline. And as that wavers over time a little bit, as a function of maybe life events, right?
Yeah.
How that impacts the actual investment decisions, and then eventually, obviously, P&L.
Yeah, I think that I brought up this concept before about like the time machine. Like if all of us could jump into a time machine, put our money in the S&P 500 and just like leverage as much as we can, not deal with any of it, right? And then everyone would be like super rich. It's really like looking at your portfolio every day and getting those bumps, seeing those bumps that sort of sways you from like selling at the worst time. So I'm a huge fan of like distracting yourself, or it's tough, not looking at your portfolio, especially not look at it every day. You hear all the time about people, they put money in their 401k and then whoa, I didn't realize I have this much money, right? Whereas the person that looks at it every day, they're going through a lot of pain.
Yeah.
This reminds me of a conversation I once had with Victor Sporandio, the person that was a dedicated short trader. And he was sharing that, because I asked him, how do you perpetually short the market because you're a dedicated short trader in a rising market? And he was saying that, it's because I'm mentally prepared to lose 8 trades out of 10, and the 2 trades are the money makers. So then on reflection, I realized that I don't have the guts to tolerate such a losing frequency.
Yeah.
And so I kind of looked in the mirror and said, I'm the guy that likes the 8 wins and the 2 losses. And so every time when I pick an opportunity, I would ask myself, is this opportunity going to fit into the 8 win 2 loss scenario, or will it fit into the 8 loss 2 scenario? And so that's how when you talk about your earlier commentaries, this came to my mind of the tolerance level.
Yeah, I think like to be like I think about like all the top traders that I know, a lot of them are very robotic in terms of how they deal with volatility. I think poker is a very good game to sort of practice that. Sometimes you have to risk it all. Sometimes you have to go all in, and it's painful. But that's the move with the if that's the move with the highest positive expectancy, then that's what you should be doing. There's also the saying, I forgot who said this, but like the most important part of your body as an investor is your stomach. Definitely agree with that.
Not the brain, is it?
No, not the brain. Yeah, or ignorance in the 401k case for a lot of people who just like set and forget. Any other things that I'm missing here? So this is a quote that I liked. It is difficult to get a man to understand something when his salary depends on his not understanding it. So with the scout mindset, they talk about the soldier mindset, where it's very defensive, whereas the scout mindset is where you are sort of open to learning new things and challenging your assumptions. And I would actually argue that in many cases, the soldier mindset is actually advantageous. And so my question is, how can having a soldier mindset be a rational strategy in certain financial contexts?
I suppose the only thing that comes to mind is, I suppose you invest in something, right? And there's sort of bumps along the way. You stick it out anyway because you've picked like, an index fund of some sort. And so any analysis you do in sort of the short term, that's counter to the overall trend is probably
Yeah.
wrong.
Yeah. Because you're emotional, and and then you have like recency bias. The market's going down, you think it's going to go down forever, right? Whereas 5 years ago, when you decided that just buying an index is a good idea, you might have had a more objective viewpoint.
Yeah. But is that a soldier mindset? Sort of sticking it out is that I don't know. It sounds like what is the other one? The scout. It sounds like a scout, isn't it? Like you're applying some wisdom to it. You're saying, yes, I see that it's dipping, but the scout's seeing a bigger picture, I suppose. So maybe it feels more like a scout to me than a soldier.
Yeah, I think there's a story from the Ulysses where he like ties himself to the boat so he can hear the sirens sing, right? So like he knows that he's going to be irrational when he sees the sirens, but so like the scout part of him knows this ahead of time and ties himself. So that's I guess two different ways of looking at the same thing, but yeah.
Or how about borrowing from the machine learning concept, the soldier mindset is the supervised learning, the scout is the unsupervised learning.
Let me think about that. So unsupervised is basically like you don't have a target, you're basically just looking for some sort of pattern, whereas the soldier mindset, he has a parametric approach to the problem, right? So he has boundaries and expectations, right? Right. Yeah. Right. Yeah. I could see that for sure.
No, I've read half the book, and my impression is that the soldier mindset is one where you don't really have an interest in the truth. You're more interested in something else. Maybe you want to be comfortable. Maybe you want to be part of a group. You maybe ego, something like that.
Yeah.
But sort of moving away from objectivity and rational thought. That's what I took. It meant that's what the soldier mindset meant.
Yeah.
And the scout was interested in the truth and is aware. He or she's aware of all these other elements. Yes, you can be swayed by maybe what all your friends are doing or what strokes your ego, what have you. But in spite of that, the scout is moving towards the truth.
Yeah.
Is that accurate? Did I?
Yes.
Digest that accurately?
Yeah. So I think like actually the biggest case or the most obvious case for where it's advantageous to have the soldier mindset is when you're dealing with other people's money. Yeah. So heads I win, tails you lose. Mm-hmm. And that's why I think like having skin in the game is like so important when you're trying to evaluate an investor, an asset manager. It's like the mismatch of incentives is so prominent when there's no skin in the game. Okay, so I stole this diagram from Anti-Fragile. Actually, hold on. From Nassim Taleb's book. I'm not sure if this image is from that book or maybe somebody summarized lessons from it. But basically, when you have that soldier mindset, your ideas become very fragile, right? Because you don't subject it to scrutiny. Whereas if you subject it to scrutiny, then it becomes more resilient. And in some cases where it actually gets stronger. Like maybe you by subjecting an idea to a lot of scrutiny, not only are you confident that it works, but maybe you're even you're like, oh yeah, we should definitely do this, and you actually put on large size. So my fourth question is, given our tendency towards the soldier mindset, what guardrails can we implement in the investment process?
I mean, I have a bit of a philosophical take here, but I think the most effective guardrail is just self-awareness.
Self-awareness, yeah. Constantly asking yourself, like, what am I missing?
I think just sort of related, just external perspective. Very, very difficult to be fully self-aware.
Yeah.
Having even someone you just have to explain your ideas to.
Yeah, 100%. Actually, so in the book, they talk about that, and they say that it's definitely a good idea to get a third-party perspective. But even more so, it's great to get a third-party perspective where someone disagrees with you, but speaks your language. So, yeah, because like if that person doesn't speak your language, they might not have the same values as you. Their input might not mean anything to you. Whereas if you do respect them as a person and you respect their ideas, and they also disagree with you or not like your ideas, then it's more meaningful and more impactful.
So John, question on the question, if I may, right? What did you mean when you said, given our tendency towards the soldier mindset, why that? Is that an assumption, or is that, how are you making that claim?
Okay. Right. So I think more people are sort of closed-minded than open-minded. So maybe that's unfair. I think that like dumb people and smart people are both sort of guilty of it, right? I'm like, yeah, if you're dumb, then you're not aware, and then if you're smart, then you might have a little bit of knowledge, but you could be Mount Stupid in that previous chart. So I think I think there's definitely special people out there who don't have the soldier mindset or don't need to work on it. But I would say, most people are. I think a lot of investors are. Obviously, there's a lot of retail people that are like that, and maybe like the people that are successful are the ones that do have that scout mindset.
But also by nature of the development of a soldier mindset, where at the end of the day, the soldier mindset comes because the person likes to rely on set parameters in order to progress ahead, then with that type of development, he would definitely be seeking out fellow soldiers with similar mindsets.
Yeah.
And that forms a pseudo guardrail, because he says that, hey, I have a whole cluster of individuals who agree with the way I think. And it will be a very, very difficult pull away from adopting somebody who thinks differently. So by nature of him developing into a soldier mindset, he would definitely resist opposing guardrails or opposing views that could have acted as a good guardrail.
Right. Yeah.
Right.
Yeah. It's.
You know what I'm trying to say?
Yeah.
So I guess.
Yeah,
so perhaps one good guardrail to propose, if let's say if I fall into a soldier mindset syndrome one day, is that the P&L, right? That if I consecutively lose money, then that's my best guardrail that I am wrong, as opposed to fighting the fact that because it's the saying, money talks, bullshit walks, right? So if your P&L sucks continuously, then something is definitely broken.
Yeah.
Would that be a consideration? Yeah.
I would like to challenge that, because number one, like that makes sense when we're talking about like a game of chess where there's no randomness, right? Like if you're losing in chess games all the time, then you do suck. But once you throw in randomness into the equation, it becomes this cloud that, like, yeah, maybe you lost money because you do suck, or maybe you lost money because the market's down, or I think that's where it becomes really dangerous. And I think that the person that gets lucky when they go to Las Vegas is at a very vulnerable situation, right? Because they made money and like, oh yeah, I have these results here, right? And then they kind of go with it. Yeah, and I think the same way with like losing money as well. The market was down 2 years ago. Does that, in that case, I'm sure there's a lot of people who risked off. And actually, I have some investors who did that as well. It's like the worst possible time to risk off is when the market turns, right? Because that's it's going to bounce back up. So I think it's hard to say that, oh yeah, just look at your P&L and then let that be sort of use that as a guide because of randomness.
True. Agree.
Actually, I feel like what you're describing is the utility of the soldier mindset. It's like you want to be the scout when you're developing the model and validating the model and deciding to put the model into production, but then you have to be a little bit of a soldier to stick with it once it's in.
Yeah. It's like, it's kind of like a marriage, right? Like you make that, you do all this research, and then once you commit, then you stick it through. Yeah.
Dr. Jekyll and Mr. Hyde.
So yeah, I like the idea of regular reviews. I think one of the things that I have to do all the time at Apple is give presentations about research and constantly getting feedback, very nitpicky feedback. And I think that's extremely helpful because it helps solidify my knowledge and my understanding and my confidence in whatever project that I'm working on.
Jonathan, what about having clients? Do you feel like that helps you because you have to explain to them what's going on?
That's a great question. It really depends on the type of client, right? There are some clients that I trust, and some I don't, like intellectually, not intellectually, but more like conceptually. So, part of managing money for people is to prevent them from doing things that they would have done otherwise, like selling at the worst possible time. I guess there are two types of clients that are good. One is like they just completely trust you and they don't ask any questions. Or two, they get it and you can explain everything. I think the ones that are kind of dangerous, like they know a little bit, but not enough, and then they get scared easily, and then So yeah, I actually do very little explaining to clients. Maybe that acts as a filter because I do want clients that do trust me, and so that's an interesting question.
Yeah, and at the same time, you don't really know whether the client wants to hear an explanation in the first place.
Yeah, sometimes people just want to be lied to, right? Like, do you think the market's gonna go up or down? People ask this. What do you think the market's gonna go, right? And in the beginning, I answered truthfully. I'm like, yeah, I don't know. I don't know where the market's going, and I don't care where the market's going, right? Like that's not the game that I'm playing, and that my claim that nobody knows where the market's going. The people that do say that are BSing you, but maybe clients want to be told that. Yeah, I don't know.
So back to your question, right? So tendency of the soldier mindset in the investment process. So I guess earlier on with the suggestion of a conditional mindset, where you're developing the model, you have the scout mindset, and when you're executing the model, you have the soldier mindset.
Yeah.
So that kind of fits in well with the investment process, right?
Yeah. I don't even remember, like, there are instances in the Jim Simons book where they're losing tons of money, and everyone had the soldier mindset. Oh yeah, stick through. We did this research several years ago, and Jim Simons had a different approach. Like, well, surviving is much more important. I mean, it's like anything else. Balance is important. It's hard to know, like, sort of how much soldier and how much scout is important.
But then that also brings into mind when LTCM experienced the spreads widening, and they continue to adopt the soldier mindset by doubling up as what the strategy warrants.
Yeah.
Right. So at what stage of the compounding of the losses based on the perceived strategy that you're executing from a soldier mindset reaches a threshold that says, oh, common sense needs to step in?
Yeah. I mean, one may argue, like, maybe perhaps during the research process, as they're developing the strategy, maybe they didn't have quite the scout mindset that they should have, right? Yes, they were maybe overconfident during execution stage, but maybe that's a function of being overconfident during the development stage.
Or how about one more to consider, and that is if the trading performance experiences X amount of consecutive drawdowns in a row after a specific threshold, that could act as a guardrail for a stop and evaluate.
Yeah. So I kind of, and Faust, maybe you have more experience with this, but I would say, like, the drawdown of a strategy in backtest is a very poor indicator of the drawdown of a strategy going forward. There's some, like, mathematical properties where this is not indicative at all. Like, you can't look at a backtest and look at the drawdown like, oh yeah, that's what I can expect going forward.
Right, but drawdown will then demonstrate, or at least it will then cite a magnitude of the loss. But on the other hand, what I'm considering or suggesting is the frequency of the consecutive losses as a pull trigger.
Right.
So if your backtest indicates that a cluster of consecutive losses maxed at 6 consecutive losses, and so it's within expectations to tolerate 6 consecutive losses. But if your actual trading strategy is 7, then perhaps that 7 could be a threshold to stop and review. How does that sound?
Yeah. I think, it definitely depends on the type of strategy that's being implemented. I feel like it's like a slippery slope, just sort of like, oh yeah, now, in a backtest, oh, we reevaluate the strategy, we risk off after this many drawdowns. Yeah, it's a tough problem for sure.
Yeah, I think it's hard to use the returns to drive. It's hard to. I mean, certainly have like caps on your losses and stuff like that, but I think you have to be a little bit more specific to the strategy to evaluate whether it's behaving as expected or not.
Yeah.
You know, I think just returns are just too noisy.
Yeah.
You know, it's my experience. Like when things go wrong, my experience is pretty limited. But you know, for us, we had one picture of like the risk exposures that we had, like the factor exposures that we had, and we didn't realize that like momentum was creeping in. Momentum exposure was creeping in over time, and momentum is very volatile, right? So it can reverse pretty drastically. So, you know, what I wish is that we had observed like the, you know, sort of movement in the behavior of the portfolio, like a little bit lower than just the returns. Like what's the composition, like what's changing.
Right. Yeah. I like that. So basically you have different guardrails outside of returns. Composition, maybe volatility, right? Maybe not the number of, you know, consecutive drawdowns, but maybe just volatility in general.
Yeah. Or if you have like inputs that you're using, you know, if there's turning points in the inputs or, you know, unexpected distribution in the input variables.
Yeah. Right.
But wouldn't it be when you're experiencing consecutive drawdowns, your volatility that you're looking at will be spiking?
Yeah, I think they're definitely correlated for sure.
I would be inclined to. We also did like cross-sectional stuff, so I wouldn't. You know, if you're just counting like days, such a small number of data points, it might be more interesting to say like, oh, I expected to be directionally correct on 51% of the positions we put on, but it was 49%. So what's going on? Something's wrong.
Yeah. All right, we're a little bit over time. I wanted to share this one last chart, and this is from the book Only the Paranoid Survive. I haven't read this book, but basically, you know, I think for any strategy or a business in general, like there are these like inflection points where you know you have to, maybe you're not aware of something and then shit hits the fan, or maybe there's a great opportunity and you kind of miss it. So my question is, how can we incorporate a paranoid mindset into our investment process to better identify and mitigate potential risks? Yeah, and I kind of want to talk about, you know, what sort of my experience. I mean, there are many times where you see a great trade, right? It looks fantastic, and if it looks good, it looks really good. Like the better it looks, the more scary it is, because then you're constantly asking yourself, you know, what am I missing? Why is it available? Like why isn't anyone else getting it? And you definitely have to go through like these mind games to try to figure out, you know, what actually happened. Maybe there is a great opportunity, but maybe there's not. And the analogy, and I think about this too, because, you know, I got two girls, and they're now, my oldest one is at the age of where they're taking like math competition tests, and you know, you know, like sometimes they go through a question and it's like super easy for them, and I'm like, okay, well that's if you're on the hardest questions and you're getting it super and it's coming super quick, you got to be paranoid a little bit and really figure out like what is going on, what are you missing? Yeah. So how can we incorporate a paranoid mindset into our investment process to better identify and mitigate potential risks?
There's a bit of a conflict because the paranoid mindset would most likely imply that you would be taking down risk because you're afraid. So the paranoid mindset does not really increase risk, but the paranoid mindset actually reduces your money-making opportunities. So it minimizes your return potential. Would that be unreasonable to think?
Yeah, I mean, yeah, it kind of goes back to what we're talking about. You know, you do the research as a scout, and then when you implement it, then you have that soldier mindset. But there are other things too, where you could be paranoid about, like for example, automation, right? Everything looks great when data looks good, but then you get a bad data feed, and then terrible things happen. You know, we all heard about Knight Capital, where they messed up really big. So those type of things where you can't be paranoid, you know, especially with the execution.
Perhaps to share an example that I experienced a paranoid mindset was it last year or the year before? Last year, I think. I bought SMCI, Semi-Micro, at 80, and I was thinking that was really nice, but I was a bit afraid because, you know, wasn't sure that this looks really good, but is it really that good? So was paranoid with that trade. So getting it at 80, I didn't have the guts to hold it till now, which is 900, because I was thinking that that could be a Game Boy setup, but fundamentally it didn't look like it. But the paranoid mindset was because I didn't visit a company and have a look-see at the hardware, I wasn't convinced of holding it for an extended duration. So perhaps in my case, at that paranoid mindset, failed to generate the best return possible.
Yeah. I mean, I think there's a distinction between like being paranoid and then acting on every thought that you have. Like sometimes being paranoid and not doing anything is optimal.
So John, question on the question again, if I may, right? Why are you saying that having a paranoid mindset is better to identify and mitigate risks?
So I think that what's the most dangerous are the things that you don't know, right? Like the things that you don't know that you don't know. I think those are the things that can be the most dangerous. So, protecting you from that is really important.
I guess I'm just trying to think about how you're using the word paranoid, because I think of paranoid, I think being unreasonable about the risks involved is how I see it.
Okay.
Right?
Yeah. Okay.
But I don't think you're using it that way.
No, I'm not using it that
more
way.
formally than that.
Yeah.
Okay, got it.
Perhaps another angle looking at it, like earlier on from a VC point of view, without a paranoid mindset, a greenfield opportunity looks really, really attractive, right? Because it's greenfield. But if you have a paranoid mindset, it could have saved you the risk, because some green fields are green because there is an intention that is green because there's a big trap in front. Does that help with the paranoid mindset?
Yeah. I think of it as, can I be wise, as I make this decision? Can I uncover the truth, like sort of the absolute truth, to the extent I can? It is the idea is to tend towards the absolute truth, even if you're not able to successfully get there. But I realize that these are just semantics, and that John's using the phrase in a different way than I'm thinking of it.
Mm-hmm. What I was thinking is, it's this mindset where you're assuming that there's something that you don't see, and you're gonna hunt for it till you find it.
Okay.
It's like you're resetting the game. It's kind of like turning the chessboard around to play the other side, so you can see maybe the attack that you weren't thinking of.
Right. Yeah.
Like in chess, when I play chess, often I play too aggressively, and I just get like very focused on the line of attack, and I forget to watch the opponent. Right. So you have to be paranoid in that situation. Or I remember talking to someone about their investment process, and they said that they didn't have a trade selection process. They had a trade deselection process, and that they had this like culture where to win the game, you found the reason to not do the trade, which I thought was super interesting.
Okay.
And how are they doing? How's the firm doing?
That was actually a fund of funds, so
okay,
they're doing well. There, I think actually paranoia pays.
Yeah.
Okay, so that was my last question. We are 15 minutes over.
These go quick.
Yeah, they do. Yeah. Thank you for participating. I'll send out the slides.
Yeah. Thank you, guys. I love the way that you put a twist on each of these books. So thank you so much.
Awesome. Thank you.
Thank you. I enjoyed this very much. Thank you.
Thank you. See you later. Bye.
Good night, guys. Bye.